This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Although we've done all the numbers, I want to finish off by just talking through two more of the accounting standards. We've already been through most of them. We went through accounting standard number 2 last time, inventory. Accounting standard number 7, cash flow statements. I mentioned accounting standard number, was it 10? Post-balance sheet events after the reporting period? Yeah? Well, there are two more I want to talk about this afternoon, not for too long. And then one, which is much less important, where I'm going to ask you to read at home. It's very brief. But the first one I want to talk through is Intangible Assets. It's chapter 21, page 133. Incidentally, can I say, sorry, before I start specifically here, in relation to what I said a minute ago, as far as the accounting standards are concerned, I'm only going to leave you one to read yourself, but you, however much you understand or don't understand what I'm saying now, again, you must read back through at home. On the revision course, though, I'll give you handouts, a very short summary of the points you need for the exam, okay? But I'm not going to waste time chatting all the way through again, but I'll just give you this short summary. This is what you'll need, yeah? Learn them. However, back to where I was, intangible assets. First of all, what we mean by intangible assets. Tangible is something you can touch. Intangible is something you can't touch. All right? And what we're talking about here is non-current assets. And of course, most non-current assets, machines, land, buildings, furniture, they are tangible. You can touch them. Okay? Hello? And you know, now we deal with machines and things. They appear in the balance sheet as an asset. And of course, you will depreciate them. Apart from land, you'll depreciate them because they've got a useful life. True? However, there can be other assets that we've bought, we've paid for, which you can't touch. And although overall there are quite a few things could come under this heading, for your exam, the only two that would be mentioned are first of all goodwill and research and development. Now goodwill they can ask very little on because there are big problems later, but they're F7. But goodwill we've talked about already, but in the context of consolidations, what we mean by it. Goodwill is when your business is worth more than the actual assets are worth. You agree? Hello? And do be careful of one thing. They have tricked you here, nothing to do with the standard. If I tell you on my balance sheet the assets stand at 20,000, I said earlier, and I must stress this, just because my assets are 20,000 on the balance sheet does not mean they're worth 20,000. You agree? The true worth of them might be more, might be less. If I told you the fair value of the assets, let's say you're thinking of buying my company, you might get a valuer in and say how much is the car actually worth, how much is the machine actually worth, and so on. Maybe the valuer says, oh, they're worth 15,000. But you do agree, the value in the balance sheet doesn't really mean anything. They could be worth a lot more, they could be worth a lot less. If the fair value of the assets is 15, then obviously you're going to have to pay at least 15 for my business. For all the reasons I said before, you might pay more. Suppose I told you the value of the whole business oh, you've either had a valuer in or this is what you're prepared to pay. If I told you the value of the whole business is 50,000, tell me, how much would the goodwill be worth? How much, if you're going to pay me 50, how much are you paying for goodwill?
15.
Pardon?
15.
15? No. My balance sheet shows 20,000 assets. A value has been in and says those assets are really worth 15. With me? However, you're going to buy my business and you've decided you're prepared to pay 50,000. You're obviously paying more than it seems to be worth. The extra's goodwill. Yeah? Because the business is already earning money, sort of thing. How much of that 50 is paying for the goodwill? Say again? Not 30.
35.
It's 35. The value of goodwill, and this isn't directly the standard, but this has been asked lots of times. Goodwill is the excess of the value of the whole business over the fair value of the assets. And so here, if you're prepared to pay 50, when the assets are worth 15, the value is 50 minus 15, the value is 35,000. Now, some of you might be worried about debits, credits. I'll show you, but that's not relevant for the exam, quite frankly. But do be clear, because they have played tricks on that. I say again, if you were buying my business, even if you thought there was no goodwill at all, you know, the business is collapsing, surely, if the assets in my business are worth 15, if a valuer says they're worth 15, you've got to pay 15 for them. Yeah, I won't sell them for less than 15, obviously. If that's what they're worth, I could sell them to anybody for 15. Do you all agree? Doesn't matter what's in the balance sheet, I'll sell them for 15. Hopefully you'll pay a lot more because my business is earning money. Well, any extra you pay over the 15 the assets are worth, the extra is what you're paying for the goodwill. Are we clear? Irina, you wanted to say something?
When we say assets here, we mean net assets? Or
Oh yes, sorry, I mean the net assets of the business. I'm sorry. I mean the net worth of the business, my net assets. So when I say my balance sheet's worth 20, I mean all my assets less liabilities, you know. I beg your pardon. I beg your pardon if that's upset anybody. It's the net assets, yeah. But I'm saying the balance sheet shows my net assets as 20. For the last time, you all agree that means nothing, you know. If I say the fair value of them is 15, you've had a valuer in, that's what they're really worth. Well, again, if you're prepared to pay more than 15, it's the extra that's the goodwill. Okay? So, you are right, it is the net assets. However, this is only really asked in these statement questions. When it's been asked, it tends to be written the way I did. They give you 4 statements and they say goodwill is this minus this, goodwill is this minus this, and so on, a choice of 4. The correct answer, it's the value of the whole business less the value, the fair value of the assets, even though it strictly means net assets. Okay? All right. However, I mention that because that has been asked on its own. But the question is, what about my business? On my balance sheet, I've got 20,000. I think the business is worth a lot more. Okay? Well, it doesn't matter what I think. The accounting standard says you are only allowed to show goodwill in your balance sheet if you've actually bought it. So if you buy another company, if I buy this company, I am actually paying for an asset. Sorry, I'm looking for my mouse and it keeps disappearing. If I buy this company, I'm paying 50,000, credit cash. I'll debit my ordinary assets, you know, my machines and things, with the fair value of the assets, which was 15. Why did I pay more? I bought another asset, which was goodwill. Well, if you've actually paid for goodwill, you understand me, because you bought another company, then you can show it in your balance sheet as an asset, just like you show machines, etc. All right? We call that purchased goodwill. So purchased goodwill, I hardly need write, I've said it. But if you've actually paid for it because you've bought another company, then you can show in your balance sheet. It's a non-current asset. However, what you are not allowed to do, back to what I started to say a minute ago, my company, I might claim, is worth more than it seems because of goodwill. You agree? I am not allowed to show that in my balance sheet because I've not bought it. I may well have generated goodwill, but just because I've grown it, I think you know what I'm trying to say, I haven't actually bought it from anybody. We're not allowed to show it. We call it non-purchased goodwill. You cannot show it. Which I think is very sensible. You know, I might say, oh, I think the goodwill in my business is worth 50,000. But there are two problems. One is, you never know what it's really worth until somebody's prepared to buy me. Do you agree? And secondly, even if it were worth 50,000 this year, obviously, next year it might be worth more, might be worth less. The business is better, it does worse. Okay? So for both reasons, I cannot show goodwill in my accounts when it's my own. I'm only allowed to show it when we've actually paid for it. Is that clear? And even that they don't like. They say you must depreciate it. You know. However, there we have problems because they've changed all the rules. At F7, we have problems about each year you have to revalue it and things. But that's F7. All you need for F3 is that rule that you can show it in your balance sheet if you've paid for it because you've bought another company. Oh, think about the consolidated one. We show it in the balance sheet because it was paid for. Do you agree? If you've not paid for it, you've grown it yourself, you cannot show it. Is that clear? All right, well, that's all they can ask there, which is very brief. However, what's more important for F3, the other non-intangible asset you'll see, sorry, there are lots more, but for F3 the only other one you'll see is over the page, research and development. Now, although I've typed it, I'm trying to save you time. So there's not a lot here, listen carefully. What we're talking about and why. What we're talking about, before I give you definitions, is things like drug companies. medicine drugs. You know full well that drug companies might spend millions developing a new drug. Do you agree? And what they're spending the money on is not so much buying machines and things. Obviously, if they were buying machines, they appear on the balance sheet. But drug companies are spending this money paying scientists and people, you know. And so they've not actually got a tangible asset. Instead of spending $1 million buying a machine, they've spent $1 million paying the wages of 100 scientists. And until there was an accounting standard, there used to be arguments. In that, on the one hand, obviously, normally, if you pay wages, it's an expense in your income statement, obviously. Yep. But they would say this is different. Because this $1 million I've spent paying wages, because it was producing a new drug, they've done all the research and found this new drug, that's going to be earning me money for the next 20 years. And so why can't I treat it like a machine? If you buy a machine that'll last you for 20 years and earn you money, you put it on your balance sheet and you depreciate. So they say, all right, I haven't bought a machine, but I've spent $1 million finding a new drug, which will earn me money for the next 20 years. Why can't I put that on the balance sheet and depreciate? You with me? And there used to be this argument. You know, you can understand the argument, that's a good argument. But then other people would say, but, you know, there isn't anything to touch, obviously. It's wages. It should be in your income statement. Well, they came up with an accounting standard. And first of all, they made a distinction between what they called research and what they called development. And they said, first of all, research, we'll call it research when we're searching for a new product, like a drug company, but the important thing here, think about a drug company. They may spend millions looking for a cure for cancer, but what makes it research is that they're not sure whether they'll actually find a cure, or even if they do, they're not sure what it's actually going to be. You understanding me here? That I'm spending money looking for a new product, but we're not certain what the product will be, or if we'll find one. Well, that we call research. Now, I'll tell you what the rule for this is in a minute. But that's research. You're looking for a new product, but again, you're not sure what it's going to be. Okay? On the other hand, think about, BMW. Maybe BMW are thinking of bringing out a new car which runs on water instead of, what do you call it? We call it petrol, benzene, yeah? But runs on water. So they know they're going to make this car, but they, of course, might spend millions actually designing it. It'll take them several years to get the car ready for sale. Would you agree? Hello?
Yes.
Well, when we know what the product's going to be, we call it development. Development is when we know what the product will be, But again, they might spend millions on engineers and things, not making it, but actually getting it ready for sale. You with me? Designing it and everything. So we know what product is. We're spending money to get it ready for sale. Now, am I making the difference clear, please? Development is when you know what the product is, but you're spending money getting it ready. Even a drug company. They may know they've found this cure for cancer, they've got the product, but they need to spend more money getting it ready. All right? Research is when they're looking for a product, but they're not yet certain that they'll even find one, and they're certainly not certain what it's going to be. Okay? Right, the rule is this. If it's research, you cannot show on the balance sheet. The word is capitalise. Capitalise? Capitalise. I think we've had the word before. Capitalise is show on the balance sheet. Well, you can't. You are not allowed to put research as though it's an asset. You must charge as an expense in the income statement. So you can argue all you like, but there is the rule. Is that clear? Come on, I don't want to keep pausing, but if I'm not clear, do shout. On the other hand, if it's development, BMW has spent $1 million on scientists, engineers' wages, but they know what the product is, you know? If it's development expenditure, you must capitalise. It's not a choice, you must. And again, by capitalise, I mean show on the balance sheet. It's a non-current asset, but it's intangible. You know, it's wages and things. It's on the balance sheet. You must show on the balance sheet, but like all non-current assets, you must then depreciate it. You must depreciate over the expected life of the new product. Now we clear what I mean. You know, they're producing this car, they spent $1 million. Well, when I say the life of the product, I mean how long do they think they're going to get income from it? If they think this new car, they're going to be able to sell it for the next 10 years. They'll depreciate these development costs over 10 years. If they think the new car will be selling for 5 years, they'll depreciate over 5 years. You all clear what I mean? We changed the words, but this won't be a problem for you. Instead of calling it depreciate, we call it amortise. But amortise means exactly the same. We use the word amortise, though, when it's intangible. We use the word depreciate when it's tangible. Okay? However, although you must capitalise to be properly development, there are 4 conditions. You must capitalise provided, I've virtually said it, they're at the bottom. Number 1, we must be clear what the product is. must be certain of the product. It's no good BMW saying, oh, we're looking for a new way of powering a car, but we don't know what it's going to be. That would be research. Here, we know it's going to be a car running on water. You with me? Not only must you be certain of the product, you must be certain that we'll be able to make it. You know, that if this needed some special material that we can't even buy, then it's rather irrelevant. We've got to be certain what the product is. We've got to be sure we're going to be able to make it. You must be certain you'll be able to sell it. People will buy. Now, of course, you're never certain about anything, but you must be reasonably certain. There must be a clear market for the product. And finally, but the obvious one, you must be able to measure the amount. To measure costs. I mean, that's fairly obvious. How could you put anything on the balance sheet if you couldn't measure how much you'd spent? You with me? So it's the first three that's really important. You must put it on the balance sheet if it's development. You must. But only when you are pretty certain. You know what the product is, you're certain you can make it, you're certain you're going to be able to sell it. Then it's development, then it must appear on the balance sheet. Is that clear?
Yeah, but it's tricky.
Oh, it's like all the standards. In real life, all right, at extremes, you will be certain. But of course, there's lots of situations when, it's a matter of opinion. All right, I'm afraid it's up to the accountant's opinion. But there is the basic rule, okay? The accounting standard can't tell you how certain is certain. But there is the rule. And it's basically, is there a product we can sell? Do we know there's a product we can sell, or don't we? And again, I hope my examples were clear enough. Drug company? Obviously we hope there'll be a product, but we don't know, we're not certain. Fine. You must have it as an expense in the income statement. BMW, they certainly can sell this water car. They certainly can make it. It's just going to take a few years, to actually design it properly. Well, fine. Then they must capitalise it. Are we clear? Finally, though, one trick they often throw in the exam. When I said about the drug company doing research, looking for a new drug, I said, they're spending all this money on wages for the scientists and so on. Yeah? That's intangible. But of course, maybe they've also spent $250,000 buying a place for the scientists to work, a building. Maybe they've spent another 100,000 on scientific equipment, yeah, microscopes and things. Well, if you've bought any tangible assets, you've bought a building for them to work in. You've bought scientific equipment. Yeah. If you've bought tangible assets, then there's no argument. It doesn't matter whether it's research development. Tangible assets will always be on the balance sheet and you'll depreciate. So watch for that. The rule only applies to the intangible, the wages side of it. Always tangible assets, buildings, machines, etc., or equipment, etc., Again, it doesn't matter why you're doing it, you always capitalise and depreciate. And that's it. Okay? So watch for that, you see. What they've done lots of times is said, this company spent $1 million, 800,000 was on wages, 200,000 was on a building. They ask you, how much will be on the balance sheet? Well, whatever happens, the 200,000 is, because it was a building. The 800,000 wages, well, that depends. Was it development we were paying it for, or was it for research? Okay? Are we clear? They're trying to trick you, you know, people want... But the 200 always, if it's tangible, is on the balance sheet. All right, that's what I wanted to go through.